What's up, guys? It is the 8th of April, and another Tuesday has hit us, and we're seeing a lot of stuff happening in the market today. But what I want to do is bring my buddy Oggie on to talk a little bit about what he sees out there. So he's big into helping the investors on the sales side, purchasing the investment real estate, analyzing the real estate. And we've had an opportunity to travel together recently, go out to Florida, spend some time learning from some smart ass people, and we got to conversing about where we think rates go. And I'm curious about his theories. So welcome on, Oggie.
Thanks for having me, man. It's always to have debate with you. I can disagree with you, and you disagree with me all the time too. So
Exactly. And I say, well, I think that's how people come to conclusion that makes the most sense to them. So as far as our disagreements, what they do is they lead to consensus a lot of the times because we're looking at things from angles that maybe we didn't see before.
yeah, I'd love to see why I'm wrong because I have an idea. I'm not an expert in these things. I just follow things. I read things. I follow experts and kind of make a conclusion like from multiple things. But hey, I'm missing something definitely. So, but
And in
having a plan is good. Any plan is good. Without sitting and doing nothing, just you don't get anything.
100%. And as far as I wouldn't say either of us are wrong because we haven't found the outcome yet. We're right now we're I wouldn't say guessing, but more or less guessing with data as to where we think things are going to end up. And I'm following price action on the bonds. You're following various different news. And so, what Augie and I have been talking about is where things are going as far as interest rates. That's the whole reason I even started this channel was just update
Yeah.
what's happening with the interest rates. So your most recent comment had to do with us reaching the fives again. Now when we quantify the comment, you're talking about us reaching the 5% interest rates for owner occupied or for real estate investors.
Owner occupied.
Okay.
Owner
So that's a
occupied.
lot, that's a lot easier achieved. Now we're talking
Yeah.
5% or just breaking into 5.99.
So I'll tell you why. So let me go backwards. First, we're going to be on the record today. So what we're going to talk about, we can come back in a year and see if we are correct or not. It's going to be on the record. So first, why I want to know what the rates will be for owner occupants. Because I'm in real estate and I buy rental properties. I help people build rental portfolios, whatever. So we need to know what the general prices will do. So, and any market is based on supply and demand. So now we have to figure out what the supply and demand is going to be. And at the moment, even though we have slow demand, we have a slow supply, almost no supply across the board, the whole country. Just the demand is very low. So why the demand is very low? Because we have high mortgage rates. So what's going to happen if the mortgage rates go down? All these people that are sitting on the sideline, they're going to come back into the market and they're going to push the prices up. So that's why I need to know when these mortgage rates will go down. So I can kind of predict at what point the people sitting on the sideline will come back. And these are the owner occupants. They're going to bring the demand back into the market. And we already have a low supply. So when you have demand with low supply, then we're going to have price increases. And that's what I'm looking for when my portfolio is going to go up.
You and I do not disagree on that. We don't both know that when the rates go down, because we have successfully programmed the home buying public that you want to watch the rates. They're all trying to target the rates. And if and when they go down, and now achieving the fives in the owner occupied world is not so inconceivable. Now we're talking about 5.99 or 5% even. That's a big window. It's a much bigger window. But if we're breaking into the 5.99s, then yeah, that is not really that far off compared to considering where the market's been. We've actually been very, very close to it in recent. I think in September we were very close to that.
Yeah.
Like you said, it's going to spur that buying. It's going to spur that demand. But there's also not as much supply. So with an increased demand with a lower supply, you can see a monster increase in price. So if there's some way, there's going to be to me, that's going to create a problem. We have two reasons why we don't have the demand that we had before. Interest rates part of it. The other part is the price has gone so high because the interest rates went so low. We haven't seen a receding of the price. And what you're just arguing is we're going to see the prices go up again. So it's not like we're going to see an equilibrium in the pricing. we're going to see if interest rates do go down, we're going to see that demand increase. It could be a nominal demand increase, but it's going to force a larger price increase. So the argument for every 1% drop in interest rate, you're going to see a 10 to 12% increase in price. So those of you who are waiting to see some sort of price crash or some sort of decline in the value of real estate, I think you and I are on the exact same page. I don't anticipate that happening.
You never know what's going to happen, but right now, there's no reason to even talk about crash. There's no reason, unless speculation and try to sell something to someone out of fear.
Speculation caused the 2008 crash. Way too many speculators, not enough real estate investors. There was a lot of speculators, people throwing money in the market, anticipating something that we'd never seen this kind of supply. The supply situation in 2008 and pre-2008, so from mid-1990s to 2008, we saw an enormous supply. But we also had enormous capability to get financing because people can get the no-income, no-asset loans, all the stated income loans. It made it so easy to buy with such a monster supply that we end up in a position of a crash.
Yeah, so for crash, you need two main reasons. First, motivated sellers. Mm-hmm. And second, the actual market, the local market, people leaving the local market. These are the two major reasons for a crash in the market. So if you don't have that, we don't have that. Sellers have so many options. They have low interest rate. They have a lot of equity. They can rent. There's multiple things they can do not to go in foreclosure.
There definitely is. So I'm going to pull up my mortgage-backed securities charts because this is how I know where rates are going, what they're doing.
Oh, now, we got killed yesterday on the bond.
Yeah, but let me, I'm going to show you a lot of stuff on that too in a minute, but let's go back and look. The last time we were in the fives for owner occupied, last time we were actually
That's what I actually looked when I made that comment about the fives.
Yeah, we were, the last time we sat in the fives and sat there strong was back between June and September of 2022. That was right in here. And so what I did is I marked this window. Now, it's not a precise window. All I did was go look on Freddie Mac's website, download the history of the mortgage-backed security, download the history of the 30-year fix from Freddie Mac itself. Now, are these precise? No. But I pulled this window together based upon that time. We got out of the fives in September 22. We broke into those fives coming up from the fours when we broke into it in June. So I drew this window. Now, if you go all the way across to where we are today, we would have to, and this is on the Fannie Mae 5.0. It's the closest I can get to a coupon that would be usable in the fives. We'd actually probably be at the 4.5 instead of the 5.0. But if you look at this and we draw this, measure this out, we would have to see 309 basis point increase in the value of this security between now and that time. Now, what's interesting when you look at this, we weren't that far off just in the last few days. We were literally at, see here, we opened up 156 points away from it just 2 days ago, last Friday. So, but there's a lot of craziness in the market.
Yeah, there's a lot of speculation going on. So there's a lot of people making good money right now, but there's a lot of speculation.
A lot of emotion in the market right now. Everybody's kind of freaking out, trying to get ahead of the next trade from the next guy. If you look back here, September of last year, we were literally knocking on the fives. We were like 6.125 for the average homeowner to be able to buy an investment, to buy a property to live in. So that was the closest we got to it so far. Now, if we overlay this chart, this is one of my favorite charts. We go back to, let me see here. Now, this is where we're looking. This is currently the 5.5. That thing just moved all over the place on me. To see where we're sitting at right now. So I can see this is what I like to do, show where I believe interest rates are going when I'm basing it off of old price action. Now, I love to draw channels and see where the market is trending and say, okay, I love to be able to lock it up here, float it down here when I'm doing a conventional lock. I'm doing a lot of DSCR, so it doesn't count as much. But we saw another channel forming, and I drew this channel out probably about a month ago, and I was seeing this thing form, and we broke out of that channel. We ran right up to which I believe is our biggest barrier. Our pricing, the value of this security in this particular coupon is not going to get any better than this, mean money flowing into it, than where this line sits and this here. This is our block where it rejects it down and it pushes traders out. So we broke out of this trend line that I had seen, this trend channel, hit that block, and immediately opened into it and went right back out of it. So we opened high, pushed right back out. Yesterday, we pushed way out. We pushed over 300 points in swing yesterday. And where did we open land today? Right in the middle of that downward channel. We are going to continue in, this is again, Aaron Chapman opinion based upon price. And I have the receipts. You can go back and look at months of these videos, and I've had these channels drawn out that we're going to keep playing this channel because that is the value of this security of people trading into it. If they buy into it and they buy more into it, it means the rates will go down. To them, their return on investment's not worth it. I believe we're going to sit here where we are right now. If we expand this channel, this whole security out, where we sit in this range, this is the value where people will trade in and make their money as a trader. That's just my opinion. But I also have months and months and months, in fact, actually almost a year's worth of data to show that that's where they're trading at. Now, I agree with you. I think we can see the fives pretty conceivably on the owner occupied. The investors, I think we're going to stay in those sevens. That's just, and that's a great rate comparatively speaking when you start looking at the history of interest rates.
I'll be happy with 6.5.
6.5 would be great. But also, what's also cool. So check out Oggie's shirt. He's wearing a shirt that says Burr on steroids. So we talk about the Burr and as a way of being able to buy your property, rehab it, refinance it, rent it, and then repeat it. Well, I like to flip that thing around. You want to refinance it before you rent it, or refinance it while you're renting it. Get an appraiser in there before you actually get a renter in there, so the appraiser is appraising it while it's in its best condition. Now, Oggie and I are on the hardcore same page with his Burr on steroids because we preach the same thing. I just named it something. I didn't even name it. I said, this is how you should properly do a Burr. Lending money to yourself. And we do that quite a bit with all our clients. So I wanted to point that out. We are not on opposite thought process at all. We think very, very highly alike. And I don't disagree with you on us getting into the fives anytime in the near future. I think that's going to happen for the owner occupied. But when guys know your property value, like you said, is going to jump. If you're not in the game today, you're losing tomorrow.
Yeah, for my personal opinion is I don't look at so narrow like you go into the details and the graphs and everything. So I'm trying to get like a macro idea of how things work and then just follow it and kind of estimate and plan my next 2, 3, 5 years, for example. So what I'm planning, what I'm getting ready for now is in the next 2 years is I'm going to be buying. Definitely buying rental properties, real estate at a good deals, because I know this no matter what, the prices will go up. There's 2 reasons to go up. Either it's going to be a good market with low interest rates, which is going to bring the buyers back and the price will go up. Or the second option is we're going to have bad mortgage rates, which is the reason for that is going to be high inflation, most likely. And when there's high inflation, the dollar is losing value, and then the prices of the homes go up again. Anyway, so it doesn't matter which one you choose, good economy, bad economy, the real estate is going to be going up. In one case, it's going to be going up with 3-5%. The other one is going to be going 5 to 15%.
You and I are, again, 100% in agreement on that one. Inflation is going to either push the prices up, or great economy is going to push the prices up.
Yeah.
And even a poor economy, even when you're talking about inflation going down, you start seeing that kind of an impact. That down inflation improves interest rates. People are going to buy, right? Just like you said. So what's interesting, what we're going on right now, we're talking about in fact, I'm going to go ahead and share another screen
share your screen again, because you pointed something that I used to kind of predict that the rates will come up to 5.
I'm going to get out of that real screen. I was going to show something else, but let me switch to that screen so I can find that one. Okay.
So the simple way I look at in the market is stock market and bond market. That's how I see it. So the rule is stock market, where the investors make more money, that's what performs better. So when there's no recession, the stock market is performing very, very well. And then all the investors move their money from the bond market, go to the stock market because they make more money. So the mortgage rates depend on the 10-year and 30-year treasuries. So when the money is going away from these treasuries to the stock market, there's no demand. In order to bring demand, we have to increase the yield, and then the mortgage rates have to be higher to get the investors back into the bond market. So that's when the stock market performs well. Then when the economy is great, there's no problems, stock market is doing well. But like right now, when the country is going into a recession, or it's already in recession, people are finding out about the recession, then the stock market is not very good anymore. It goes down, goes up. The big investors move their money because they're scared of the stock market going down, and they go back to the bond market. When the bond market performs well, then the yield doesn't have to be so big, and the mortgage rates go down. So basically, when there's a recession in the country, the mortgage rates go down. So I'm betting on the fact that we're in a recession, and the recession is going to be going deeper and deeper.
We've been in a defined recession for some time. It's been a redefined measurement of recession. Now we're finally getting to the point that we have the new presidency saying, "Oh, guys, look what's happened. We got this recession." That's already been.
Oh, we both talk about the BLS statistics. They've been lying for the labor reports for the last year. Very, very easy, very, very open, and it's easy to prove. Just go back and see it. So, but what I'm betting is we're in a recession, and the news for recession will be coming up openly. Everybody's going to be talking about it. So now I wanted to find out how bad the stock market will get. That's the question, because the stock market gets worse, the investors get scared, and they move money to the bond market. So what I looked is the same like you looked when the rates were the lowest in the fives. I went back and looked when was the last bear market ending, or was the kind of the time frame of the last bear market, and that was exactly around the middle of 2022. The same thing that
September 2022. I have it right here on the screen. The end of that bear market was September 22, which coincides with where we were at with the lowest, where we'd achieved that lower rate of.
I went back a little bit, and then I said, okay, very easily. I went online and I searched what were the average mortgage rates in July 2022. So the average mortgage rates were 5.5 to 5.9, somewhere in that range. So based on what I read, based on the different professionals I follow, read articles and things, I believe that the stock market will go down and to the same levels of middle of 2022. So then I went and okay, at that time, the rates were this. So it's like a very simple calculation. I'm not sure if I'm right or wrong. There's multiple things can happen between now and then, but this is my reason to saying I want to see fives, because we're in a recession.
Very, very solid hypothesis. Honestly, if you're looking at this right here, what you're talking about, because if you see are you seeing my
yes.
Dow? The Dow. So if we get back to, this is September 2022, that was the end of that bear market, and it took back off. That's when rates kept going up. So we saw the bottom of those rates, but we also
just have to go 2 or 3 months before that so you can see the accurate.
We're at 33,000, so we're 4,000 off of that now. Because we're at 37,511. So what some of the things when you're talking about inflation and the markets, what some people fail to really realize when you look back at the history of the Dow, and when it really started to rocket up is right around the time that we got Trump comes in 2016 comes up, and then you end up getting into the pandemic of 2020, and then look what happens after that. We get this monster rise, probably the most significant rise in the history of stocks. We broke that 45,000 mark. That all happened because of the inflationary situation in our country. Literally, the stock market grew so quickly because the value of the dollar diminished so quickly. It basically tracked the value of the dollar.
And why is the reason for that? what's the main reason for stock market going up?
The main reason for it going up, other than inflation?
Yeah.
I'm curious what your thoughts are.
Supply of money, M2.
That's exactly what it is. Inflation is the
The
supply of money.
only reason for the stock market to go up was the supply of money. In the pandemic, it was the stupid supply, stupid, crazy supply, and people were just spending on everything. They were sitting home, investing, buying. All this caused a lot of inflation. So on the stock market, some stocks,
all inflation is an increase in the supply of money. So because if you look right here, from the pandemic till here, we had 40% of our currency was done in an 18-month window during this whole situation. Yeah. That's why we had this big jump in the stock market. Now what we have, what's interesting, with the tariff scenario, the dollar is strengthening because all these agreements are being made with this tariff. So what's happening to the stock market? It's declining with the strengthening of the dollar. What's really interesting about the point you pointed out earlier, we've seen this decline in the stock market from 45 to 37 very, very quickly. But what is also interesting, look at the decline in the bonds. That bond decline over the last 48 hours of trading, basically, or 72 hours. Actually, in 48 hours of trading, we lost 308 basis points. That is a bloodbath, that much of a swing. So the money is literally kind of sitting in limbo. It's not going to bonds. It's not going to
I know what the reason is. The only reason
right away
is because the biggest killer of bonds is the inflation.
Is inflation.
Yes.
100%.
So the only thing that right now is against the bonds is because people think that the tariffs will bring a higher inflation. So that's the only reason the bond yesterday crashed, because tariffs, inflation. That was the reasoning about it. We don't know if it's going to be that or not, because we don't know what is going to increase, how much is going to increase, and then if it's going to stabilize. So speculation. I believe that if we're going to see rates in 5, the earliest it's going to be is end of this year, beginning of next.
And I don't think that that's an improbable thought process. But what I'm going to do is, my prediction always has been my prediction, our interest rates we're not going to get much lower than what they were in September of this last year. That's going to be hitting.
On the long run, yes, because here's why. We're talking about supply of money, supply and demand. Yeah. So supply of money, not supply and demand, I'm sorry. Supply of money. When there's money in the economy, there's no recession. But when there's no recession, the economy is doing good, there's inflation going up. When the money in the economy stops, there's a recession going on. So right now, we are at the moment of the economy when there's tight money. So we're going in recession. But the only way for the government or the feds to stimulate and get us out of recession is to put money back into the economy, or print money, or borrow money, or quantitative easing, whatever you call it. So that we're going to be in a recession, and at some point they're going to have to start putting money back, which is going to cause inflation, which is going to make the bond market worse, which is going to raise the mortgage rates again. So at some point, like you're right, we're gonna end up in the 5 and 6 somewhere there. But I think we're gonna have a gap of 2 or 3 years. We're gonna have low interest rates.
Well, you mentioned, the quantitative easing. So to go back as to why I say we're not going to see much better than what we saw in September, this is the day they announced quantitative easing right here in 2008. It was announced in November 8th, 2008. They announced it. This was the trading done by the market that day. They traded pretty high up, and they settled in this window. So it's nearly a 100-point day, and that is just shy of a 100-point day that the market itself bought into mortgage-backed securities that day. Now, the Fed actually started quantitative easing January 2nd, 2009, when they started putting money in. So this is the value of the security when the Fed started putting money in. So everything started going in above that. So this is all because the Fed was throwing in money. That's the only way we'll get lower than that. So fast forward all the way today, I have that same block drawn here. This is where the market itself, without Fed involvement, has been hitting in here and backing off it. That's why I say that's our barrier. And then we have another barrier even higher when we look at the actual value of the security once the Fed start putting money in. So if the Fed starts announcing quantitative easing again, I think we could break through it and start getting to that point. But if they don't announce quantitative easing. They're just, even if they back off quantitative tightening, I think we'll still play in this range because we're still in the quantitative tightening phase. But ultimately, without the Fed saying we're going to put money in the markets too, there's no way that that's going to happen. I don't see that happening at least over the next 4 years because we do not have a presidency is going to say go ahead and use public money to go buy in the markets. They're not going to.
I don't think they'll start printing money right away. But the first thing they'll do is they'll drop the Fed rate borrowing so it can start circulating more money, like more borrowing. That will be the first reason. But so
we saw the Fed drop the rate three times this last year, and it pushed the rates up every time because again, it was an inflationary move. So very
and we both know that it's not about what's going to happen; it's about the signals that the Fed's is sending. Yep. If they're lowering the rates, they're signaling to the market and to the investors we are in a recession. And when a recession, then we're going to have to stimulate the economy. So when we're in a recession, everybody runs away from the stock, goes to the bond. And in a recession, because there's less spending, that contracts the economy and the inflation goes down. And when the inflation is down, it's really, really good for mortgage-backed securities and the mortgage rates go down. So unfortunately, the worse the news are for the economy, the better is for the mortgage rates, which is better for the real estate market.
Yeah, it's one of these trade-offs, right? Well, this is Aaron Chapman opinion. When you look back, like what you're saying, the signal of the Fed lowering the interest rates was a signal things were going about the economy. I believe those federal rate drops this last year was more political pressure, not actual response to the economy. And as a result of that, we saw a negative outcome to that. Completely opposite what people thought was going to happen. What's your final thoughts, dude? Because we got a couple more minutes.
So just for everybody out there, the simple way to follow the rates, to predict the rates is, well, first, inflation. Inflation goes down and up. Lower inflation, lower mortgage rates. High inflation, higher mortgage rates. Worse recession, lower mortgage rates. No recession, higher mortgage rates. This is the basic rule to follow, kind of trying to predict the mortgage rates.
Yep. And when the economy is in standard cycles, I believe that all holds true, but we also eliminated cycles with quantitative easing. We still have to work that out, all that excess capital in the market and the economy. But I appreciate you coming on, brother. Again, guys, when it comes to financing investment properties, you definitely the 30-year fixed. We've got the Burr strategy. We've got the Burr on steroids, the way he likes to call it. We can get deeper in that. You can set up for a call. Go to contact Bree at my office or just text me.
Yeah, free houses.
What's that?
Getting free houses. That's it.
It's free houses. It's incalculable return. So text me 602-291-3357 and we'll catch up with you guys on the next round. Appreciate you, Oggie.